right, everyone. Well, welcome in. We are wrapping up 2025, which seems crazy, but I feel like I say that every year once we get to the end of it, because they all go really fast. So, welcome in. We're excited to be with you again. For those of you who haven't joined us previously, my name's Jared Music. I'm the CEO here at Destiny Capital and a member of the investment committee. So my role is really to be a thought partner to Tim and make sure that we're planning through how we're going to invest client assets, the tools we're going to use, the data that we're looking at, and all of that, and really be Tim's thought partner as he drives all of that for us as a firm. Tim?
Yeah, thanks, Jared. Yep, my name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital, where I lead our investment committee that oversees areas of our business like capital market research, manager selection, fund due diligence, portfolio construction, trading, rebalancing, working with our client service teams, and much more. And 2025 was a really busy year. It was a really fascinating year. We've got a lot to cover, so I'm looking forward to getting into it.
Awesome. Well, before we dive in, we do have all of these regulatory notices that we have to run through quickly. So please don't make any irreversible decisions based on the content of our conversation here. We've made every effort to be accurate and timely with all the information and discussion that we're going to have. There's a possibility we made errors. We're going to discuss a few individual securities today. We and the company and clients may or may not have investment positions in those securities. So we'll talk a little bit about those. And then please reach out to your tax advisor, wealth advisor, attorney, somebody who can help you make good decisions before you decide to implement anything that we talk about today. And reach out to us if you already work with us. Reach out to your lead advisor, your client service team. Send us a note. We're happy to respond and take action on any of that. So with that being said, what we wanted today was to dive in and look at a year in review and sort of what has happened throughout 2025, and then how does that inform our decision-making process going into 2026. So this seems like a very long time ago that this was top headline for everywhere, every day. And now we're quite a ways past it. So Tim, what happened around tariffs and what have we seen this year?
Yeah, yep. Like you said, this does seem like quite a long time ago, and things have changed quite a bit since then. But if I was going to have to pick one event that really shaped financial markets and the economy for 2025, it would be this one, and that's the changes we saw to U.S. trade policy. If you recall back on April 2nd of 2025, the Trump administration hosted what they call Liberation Day, where they were going to be announcing these new trade policies to the world, essentially. And I was on the edge of my seat waiting for this announcement. I know a lot of investors were, and we really didn't know what to expect. I think many were talking about a potential 10% universal tariff or maybe targeted tariffs to some of countries and regions like China that may have unfair trade policies against the U.S. and whatnot. But what we got instead, and you can see this in the chart to the right, were reciprocal tariffs, steep reciprocal tariffs assigned against virtually all of the global trader partners of the United States. And these were hefty numbers. I remember when I saw these numbers flash across my screen, I had to pause the footage and kind of zoom in because I wasn't sure if I was seeing those numbers right. And so, yeah, it was a lot for investors to digest in a very short time. It essentially rewrote the rules of the road for the global economy and global trade very quickly, and investors didn't know what to expect, really. So the market reaction was somewhat harsh because investors feared, a global trade war. There was talk of retaliation between, virtually all the trade partners of the United States, and that was very alarming. A trade war can lead to a slowdown in global growth and disruptions in supply chains, and we just had that with the COVID-19 pandemic, and that's not something that we wanted to experience again. So the stock market reacted very harshly in a single day, sold off about 5%, as measured by the S&P 500. The NASDAQ was down about 6%. Reuters reported that nearly $5 trillion of market cap was erased in about two trading days. So quite alarming in that regard. And then we also saw in a number of days the 10-year U.S. Treasury rate soared from about 4% to 4.5%, and that sent alarm bells across the global bond market. And I think those two things in tandem, the bond market reaction, stock market reaction, and maybe our trade partner reaction, shaped the response where the Trump administration did walk back some of those policies and announced a 90-day pause. And that allowed investors to kind of catch their breath. And on April 8th, that's when the announcement came. And on April 8th, the markets started to ascend once again after selling off about 10, 11% in just a few days. And markets continued higher from there on out. When it comes to, the impact of tariffs on, just revenues generated, that's really, I believe, one of the intents was to generate revenue for the U.S. government. And we have those numbers here where it's estimated that tariff revenue surged to about 165 to 195 billion for fiscal year 2025. And over the next 10 years are estimated to generate between 2.1 and 2.7 million. And that's between 2022 or 2026, and 2035. So, yep. Yeah, this was a big one, Jared.
That was 2.1 to 2.7 trillion. Sorry.
Oh, sorry. Yep. Sorry, misspoke. Yep. So this obviously caught the attention of investors and caused a lot of uncertainty for businesses and investors alike across the globe because we didn't know which tariffs were going to be permanent, which may be in play for the long term, how high they would be, how low they might go. So just a lot of uncertainty coming from that, if you recall, Jared. Anything you wanted to add or context there that would be important?
Yeah, I think our entrepreneur clients were definitely having a rough time because the information was changing so quickly. And so clients who have companies that make physical goods in particular, where you may be importing steel, you may be importing raw materials for a manufacturing process. I know they were having essentially daily meetings to look at the impact of tariffs on their business model. And so when you have that happening across the economy and businesses are being forced to pivot very quickly and navigate uncertainty, that hampers business activity. But it also, as you talked about, Tim, I think just really puts all of us as investors in this place of limbo going, where is this going to go, right? Is this going to be a net negative, a net positive, some of both? We don't really know. I think now that the dust has settled out a bit, we can see that the amount of revenue that's generated by this is a drop in the bucket from the federal perspective. And I hate to say that $200 billion is the drop in a bucket, but it truly is when we're, at the size of the economy that we are, and then the federal budget is where it is. So the revenue impact has not been drastic. I think the longer term element that we're mindful of is, does this do the other side of what the stated goal was, which is to bring more economic activity, manufacturing specifically, back onshore for the U.S.? Do we make more things here because now it's more price competitive to make them here versus manufacturing overseas and then importing? Those supply chains take years to build. And so we'll probably see the impact of this here on kind of a rolling basis over the next couple of years. And do we see a pickup in manufacturing activity and employment here in the U.S.? That remains to be seen. But the revenue part of it has not been a huge element.
Yeah, very good points.
Yeah, so jobs are really important to Americans, and that was part of the tariff piece here. But another really big variable that everyone has been focused on for the last 4 years really is inflation. So a little bit of an interesting path on inflation this year. And what have we seen and what are we looking at now, Tim?
Yeah. Inflation, the story that, just won't die for us, Jared. It's very frustrating to be here at the end of 2025 and we're still talking about inflation and the effect it might have on financial markets and the economy. What we saw, and you'll see this in the chart to the bottom left. I know these are very small, and we will be sending out these charts to everyone who wants one, and this slide deck itself. But what you can see on the left chart, at the bottom right of the left chart, is a resurgence of inflation in 2025. And this chart shows the components of inflation and essentially what's contributing to inflation. Is it energy? Is it shelter? Is it auto insurance, core goods? And what we're seeing is the purple and yellow or orange lines essentially start to reemerge. And that means that core goods and food at home prices are surging once again. And many economists believe that that's directly influenced by the tariffs that were implemented by the Trump administration that we talked about on the prior slide. So inflation potentially being impacted by tariffs here, and that's really concerning to investors. That's concerning especially to consumers. And I think if 2022 taught me anything, it's that consumers really are fearful of inflation and higher prices, and it's very damaging to the investor or the consumer mindset. We could see that to the chart to the bottom right that shows consumer sentiment over time. And we could see as of the latest reading in November, that's the green diamond on the far right, consumer sentiment has bottomed out at 51. Those are levels last seen since the depths of 2022 when inflation had risen to above 9%. That's actually lower than it was when we were in the 2008-2009 Great Financial Crisis. So yeah, consumers are not happy. And I think what's contributing to this is the fact that we're also seeing cracks in the labor market. And that can be very fearful for consumers, with the unemployment rate rising to 4.6% as of the latest reading. I think as you creep up closer to that 5% mark, that's when I think you're going to get a lot more attention to the labor market, at least as far as consumers are concerned. And what we're really watching for as investors is, will consumer sentiment, so will this pessimism impact consumer behavior in the form of spending, in the months and years ahead? And that's a little bit harder to gauge and remains to be seen. We haven't seen those patterns break apart yet, but that's something we're going to be watching for if inflation is persistent, if we see cracks in the labor market continue. Something to be mindful of as investors. And Jared, I don't know if you have anything you'd like to add to that perspective as well.
Yeah. When we talk about the Federal Reserve and setting interest rate policy and looking at other tools that they sort of have in their toolkit to either encourage economic growth or to slow it down, and also by doing that, hold down inflation, we're definitely in this very interesting period for them. I'm glad I'm not a governor for the Federal Reserve Board, because they're looking at a rising unemployment rate and rising inflation numbers. And that's a really tricky spot to be in, where you're kind of damned if you do, damned if you don't. If you leave interest rates alone, does the economy deteriorate? Does economic activity slow? And are more people out of work? Or if you sort of nudge it by lowering interest rates, do you spur greater inflation, which we can also see from the chart here, that inflation is incredibly painful for those same people that you may be trying to help with employment-related policies. So that's probably one of our top storylines as we go into 2026 and thinking about investment planning, is just how do we navigate this period in time? And I'm very glad that I don't have that job.
Yeah, the Fed is like having to choose between their two favorite kids, right? You've got a dual mandate there, and those mandates are in conflict right now. So which one do you prioritize? Do you prioritize jobs, or do you prioritize higher prices and bringing those back down? So yeah, it's a tough one.
Yeah. Well, and thinking a little bit outside the U.S., we've seen a bit of a diversion in between U.S. equities this year and international equities, and some very interesting reasoning on what's driving that difference in performance. Can you kind of walk us through, as we review 2025 internationally, what happened here, Tim?
Yeah, it's really fascinating. For the past 15 years, U.S. stocks have vastly outperformed their international counterparts in developed markets, in emerging markets, and so forth. And we've seen that dynamic shift, at least so far in 2025, at least as far as 2025 is concerned. You can see that in the chart to the top right, with the orange line representing essentially the rest of the world, the ACWI ex-US total return index, and the blue line being the S&P 500. So we have international stocks, global stocks, essentially up about 31%, whereas the S&P 500 is up 17%. Hey, 17% is great for the S&P 500, especially on on the heels of two consecutive strong years. But I don't know that many investors had this international performance in mind. If we talk to them, say this time last year, I don't think this was necessarily on their bingo card, at least outperformance to the extent that we've seen. So what's been driving that, right? That then becomes the question. And I think what we started to see is a shift in global policy where many governments, particularly in the Eurozone, are shifting from policies of austerity to those of growth. So that, much like the US cutting taxes and so forth, and investing in infrastructure, they're doing similar things there that has the potential to boost that economy, especially in the Eurozone, countries like Germany and so forth. So that's a source of optimism for investors, because when governments spend, that tends to provide some tailwinds for those corporations and their profitability. Then coming into 2025, about a year ago, if you looked at international valuations relative to US valuations, most investors would probably say that international stocks were cheap, especially relative to US stocks, because US stocks had two consecutive really strong years and the S&P 500 had surged quite a bit, whereas global stocks had not seen that, and their valuations were subdued relative to the US. So I think we saw a little bit of a rotation, some people pulling some assets out of US stocks, rotating them into international and emerging market equities, which helped to boost returns there. Another really important point is that international stocks also received currency tailwinds. So the US dollar declined about 10% in 2025 relative to other currencies like the euro and the yen, and that can provide tailwinds for international stocks that are held in those, for example, European stocks that are held in the euro. So when the US dollar declines, that is an automatic boost for those Eurozone stocks. So currency tailwinds were a big source of total return in 2025. And the question then becomes, is that something that's going to continue, right? Are we going to see the US dollar continue to decline, or is it going to level off from here? Can the Eurozone, can international equities continue to count on the decline in the US dollar to boost returns? I think that's a big question investors have to address heading into 2026. I'm a little bit skeptical about that, at least when it comes to a 10% decline in the dollar. Maybe we'll see a fluctuation, but 10% is a big move. Then we have multiple expansion. When we talk about multiple expansion, that means that investors are simply willing to pay more for a stock than they were previously. So in that, and we've seen multiple expansion, and that really comes from investor optimism. So investors are optimistic about international equities, so they're pumping money there, and so we've seen multiple expansion as a source of total return in Eurozone and international and emerging market stocks. And we can kind of see the breakdown of this a little bit in the chart to the bottom right that shows the composition of returns across different regions. So that on the far left, you can see where we have the Eurozone equities and the composition of those returns. So in purple, that indicates currency return. So currency was a big source of return, total return for Eurozone stocks. Then we had multiple expansion. That's the gray bar. That's another big source of return. And then we had dividends. Of course, dividends are additive to total return as well. And international stocks tend to pay higher dividends than US stocks. But what's missing here, or what's smaller, at least relative to the US, are earnings and earnings growth. So that's a story. That's really what we watch primarily at Destiny Capitals. We're looking for earnings and earnings growth from the investments that we're seeking. And if you look at to the far right of that chart, you see U.S. Earnings growth, and it's quite a bit higher than that of the Eurozone. So I still believe U.S. stocks are the best game in town, especially when it comes to earnings and earnings growth. So we aren't necessarily extremely bullish on Eurozone or international equities, but they obviously are good sources of diversification, regional diversification, and so forth. So, but there's a lot that we're looking at here as we go into 2026. It's a fascinating turn of events for this year. After 15 years of outperformance, of the S&P 500 relative to international stocks. International stocks finally had their day, and the question then becomes, will that continue? Jared, any other thing you'd like to add there?
I think this may be one of those, it's not as big news as tariffs or inflation or Federal Reserve policy, but currency issues when it comes to pricing of different securities across the globe. Nobody really talks about that. Nobody really understands that the relative price of local market currencies has an impact on your investment return profile. And so, when we see that most of that EU performance was driven by either a currency issue or people just being more willing to pay for essentially the same amount of earnings on an existing stock, that doesn't look like a sustainable investment pattern from our perspective. So
right.
I know that you're deep into the data right now as we complete our capital market assumption review, which is kind of the keystone process for our investment year right now. So we'll be having more conversations about that. But at least right now, that certainly doesn't look to be a compelling investment thesis. Let's count on people being willing to pay more for the same earnings and for currencies to continue to sort of bend a little bit.
But that optimism generally fades when earnings aren't there to support it. So, will that optimism stay intact? It's hard to imagine unless we see a rebound and significant earnings growth there. So, yeah, great points, Jared.
Okay. So now we're going to go to the Magnificent Seven. And before we hopped on this call, I was kind of laughing with Tim that we seem to kind of redefine this very tip top of the S&P 500, those very, very large tech companies. So it was the Magnificent Five at one point. It was FANG stocks. There have been others, but really looking at those top 5 to 10 companies in the S&P 500, and at various times over the last couple of years, how much of that performance they've been responsible for. So what have we seen this year, Tim, with those top companies in the S&P?
This is another topic that won't go away. We're still talking about Mag 7, and it's 2025. It's been years that we've been talking about those 7 stocks. A new term, Jared, is that these are the AI hyperscalers. That's one you're going to hear a lot of in 2026. I guarantee it. But these companies. It
sounds really cool. Yeah, I want to be a hyperscaler when I grow up.
Yep, I love it. But yeah, these are the tech titans. It's Amazon, Meta, Alphabet, Oracle, Microsoft, and they are spending on AI infrastructure build out, on data center construction, on chips, on everything they can get their hands on to build out their AI capabilities. And in 2025, it's estimated that these hyperscalers will have spent about $350 billion on AI infrastructure build out, data centers, and whatnot. And you can see a little bit of this on the chart to the right, where we show these tech titans and the quarterly spend they currently have, on capital expenditures, on AI build out, and so forth. And then on the bottom there, you have coincidentally NVIDIA's revenues, data center revenue soaring, and that's showing no sign of slowing down, especially if, as expected, these hyperscalers continue to spend. By 2027, total capex on AI is expected to reach over $500 billion, so $500 billion there, and that's a staggering number. And growth has been fast and furious. So across the globe, there are about 11,000 data centers, global data centers. We have a chart about this on the next slide that we'll get to. And roughly 5,000 of those 11,000 data centers currently reside in the United States. So when it comes to the AI arms race, the U.S. appears to be ahead. And we have the private corporations who are willing to invest in that because they truly believe it's going to be a revolutionary new technology. So that's going to be obviously something that's fascinating to watch in 2026. When it comes to year-to-date returns and the contributions of these Mag 7 stocks, over the past few years, these 7 companies have driven returns higher and higher for the entire S&P 500 index. So in past years, if the S&P 500 was up 25%, about 20% of that was due to these Magnificent 7 stocks. They were heavy contributors and they were outperforming by a wide margin the rest of the 493 stocks in the S&P 500 index. However, we've seen that change a little bit in 2025. So the dispersion in returns between the haves and have-nots has narrowed quite a bit. So you have an S&P 500 index total return of roughly 16%, give or take a day or two. That can obviously change. The Magnificent Seven stocks have produced a combined total return of 20%, and the rest of the S&P 500, the S&P 493, as we outlined there, is contributing 14%. So we're seeing, like I said, less have-nots, and everybody's participating in the S&P 500 return, at least this year, to the extent that we haven't seen in prior years. So that's exciting. That's good for the rest of the market, and it keeps the concentration risk in the S&P 500 as a whole down a little bit. So it tampers that down a little bit. But the question then becomes, with this spending spree on AI, how long will investors allow these companies to shell out cash for this AI build out without seeing an immediate return on investment? So will we get that revolutionary moment in 2026 where that aha moment where investors are saying, okay, I see the benefit, I see how this is going to be additive to the bottom line, or even to top line revenues? We just haven't seen that yet. We're kind of in a wait and see mode, and these AI innovators are promising that it's coming, but we just haven't seen the fruits of that labor yet. So will this be the year where we see some pushback from investors saying, okay, you spent $500 billion here. What's the proof that this is a good use of these corporate dollars? So, and another question remains around AI and the use of energy. So AI requires an extraordinary amount of energy. And where would this energy come from? Can the U.S. grid support it? Will be private build out? I put an example here where Microsoft had penned an agreement with Constellation Energy to restart the 3 Mile Island nuclear reactor. I mean, who would have thought that would be a headline, coming into 2025? So it just goes to show the demand for energy that this requires. So that's going to be something that's, I think, top of mind for investors and U.S. citizens in general, as there's more competition for energy resources. So, Jared, anything else you wanted to add there?
I think the energy one is a fascinating question. That will we see price hikes in electric rates, and does that become another contributor to inflation? Whether you just think about like utility companies needing to upgrade transmission or pay to extend the life of power plants that were kind of scheduled to be shut down. I know here in Colorado, both of those are happening, right? Xcel Energy is the largest utility provider, and it's requesting rate increases to upgrade infrastructure and extend the life on a coal-fired power plant near Pueblo that was scheduled to be closed, I think in 2027, and they're bumping that out to like the mid 2030s. So we're going to see demand for energy here, and it's just fascinating when private industry decides to allocate capital somewhere in a big way. When we talk about why does the U.S. tend to outperform over time, we're really good at doing that, right? We can debate whether the long-term vision of all these data centers is going to be realized or not, but what you can debate is when it's time to go find the money to put these deals together to build data centers and compute power. U.S. private markets are really efficient at doing that. So it'll just be fascinating. And I think there was an article that I read that talked about, we had a similar sort of boom in like railroads in the UK and Europe and the US at the end of the 19th century. And a lot of those railroad companies didn't end up making it. They either got consolidated or bought or went into bankruptcy. And some investors made tons of money, some investors lost money. So there were certainly winners and losers. But walking away from it, you got these national level railroad infrastructure pieces that fostered continued growth. So I think whether it's the LLM, the large language models that everyone's leaning into right now, or does that compute power over the next couple of years get redirected toward other things like health sciences or solving different engineering challenges to bring new things online and into the market. We truly don't know, but we do know that there's a massive amount of computational power being built here in the US and globally right now. It's going to be really interesting to watch how that gets sorted out over the next 2 or 3 years.
Yeah, absolutely.
I think as we look at this chart, you referenced it on our prior slide, but talking about where data centers are located. And this is probably surprising to most people. It certainly was to me to see it visually, just how much of that computational power is still here in the US. I think I would have expected, China to have a much larger share of the global market. So any comments there as we think about 2026 as well, Tim?
Yeah, no, I agree with when I saw this visual, I was expecting China to play a larger role because I believe they are deemed as the US's primary competitor when it comes to AI data center, and that's who we're really targeting when we talk about, kind of an AI arms race, US versus other governments. So, but yeah, I think it's important, we can close just by talking about some key questions, and there are a million questions that we have heading into 2026, but these are some high-level ones that are worth noting. And a lot of it ties into what we talked about already today, so we don't need to go into too much detail. But, first and foremost, will tariffs persist? So there is a case in front of the Supreme Court that, and they are set to rule whether or not the Trump administration's tariff policy is unconstitutional, and we should get a decision. Most are saying that could come by June or July, but I believe there's pressure there for that decision to come sooner. Some even thought it could come in December. That's obviously not happening, but sometime in Q1 or Q2 of 2026, we should get an answer there. And if the Trump tariffs are deemed unconstitutional, that changes quite a bit. I don't know if you can, put that genie back in the bottle to some extent, at least as far as the dollars that were already spent are concerned, and the revenues collected by the U.S. government. But obviously, that could have an impact on supply chains. Everything we've talked about could potentially change if those tariffs are lifted and we go back to, business as usual pre-Liberation Day in April 2025. Again, inflation tick up higher. We actually, before we hopped on this call, did get inflation numbers, and CPI was up, better than expected inflation numbers. The CPI up, I believe it was 2.7%, whereas economists were expecting, potentially 3.1%. So that's a strong reading. That's healthy for us as investors, and it's good for the economy. The only question then becomes, did we have a full data set due to the government shutdown? Do we have a complete picture for that particular reading in November? And that remains to be seen. So we don't want to make too much out of one reading, as we always, that's always our perspective. We don't overreact to a single reading. We want to see a trend and where that trend is headed. Jobs, that's going to be very important for consumer sentiment and everything we talked about. Consumer spending, we saw unemployment rate tick up to 4.6. That's starting to get into alarming territory. And when we see that labor market continue to crack, or will Fed policy rein that in? And, we've seen the Fed lower interest rates throughout the course of 2025. They are at what they deem to be a somewhat neutral rate, where I don't know that they anticipate significant cuts from here, but they're trying to find that sweet spot where where rates will be supportive of the labor market while also not getting the economy too heated up and pushing prices higher. So that's a tough tightrope to walk. Global equities, we talked about that. Will global equities continue to outperform in 2025? We're dubious about that, and specifically because of the earnings growth or lack thereof coming out of areas like the Eurozone that have seen 30+% returns in 2025. And we've talked about this on the prior page. Will AI CapEx, so spending on AI, will we start to see a return on that investment that's really significant for investors, or as significant as investors would want based on the total spend that's going in that direction? So there's a lot more we're thinking about, a lot more that we're considering here, but these are some high-level ones that I think it's important, questions to be asking and things to be paying attention to as we head into the next calendar year. Jared, anything else you wanted to to add there?
No, I think that's a great summation of where we've been in 2025 and what we're mindful of going into 2026. So hopefully this was helpful as we kind of wrap up the year. Would encourage everybody, please go through and use the CIO mailbag through the website, destinycapital.com. Submit questions over. We want to talk about things that are of note or of interest for everybody that's taking their time to watch this. So send over those questions. We always try and fold them into our discussion and our presentations here. So I think as we wrap up, really appreciate everybody giving us some more of their valuable time and taking time to spend with Tim and I throughout the year this year. So Tim, anything to close us out before we sign off?
No, yeah, just thanking everybody for their time. It was another positive year for investors. We're looking forward to 2026, and we really wish everybody a happy holiday season and a happy new year. And we'll see you soon in the new year.
Yep. See you in 2026. Thanks, everybody.
Right,
Bye-bye.
take care.